Welcome to the Techno Fundamental Report for April the 23rd. Don't chase success, money, or opportunities if getting them requires you to lie or compromise your values. No advantage is worth sacrificing your integrity or feeling ashamed of who you are. The Greeks. These videos are designed to be educational. I'm trying to help people become better investors, but I'm finding that some people are just unteachable. And I think the number one problem is greed and fear, where I see where some people I'm working with, I'll get them to discuss what we're doing, but I just can't teach them. They get greedy and go after things. And Buffett says 98% of people fail. So it's important to go with education. So speaking of that, let's revise and review our follow-through day, which we've been talking about for the last couple of weeks. So basically you make a low, and then you have a higher close on day one of a rally attempt. We'll look at a graph, and I'm just reminding you of the verbiage. Followed by 2 days where the stock index does not fall below the low of day one. On day 4 or later, a significant gain in price and volume confirms the follow-through day. So the whole idea here is that we're trying to see if we're just getting a one-day pop that is in a bear market and then we start breaking down again, or does it follow through? Now the next step is to go to something called a power trend. Now and we'll look at a graph on this one as well. The low is above the 21-day exponential moving average for at least 10 days, the low of the index. The 21-day exponential moving average is above the 50-day simple moving average for at least 5 days. The 50-day line is in an uptrend. The market closes up for that day, and a power trend will end when the 21-day crosses back below the 50-day. So let's go here. Okay, this is your follow-through day. Here's your low. We went 1, 2, 3, 4 days. Now that's a rally attempt. Then once we get above the 21-day and our low is above the 21-day, you can see the point there, and we'll get to that. But you can see here that since the low, we've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. We're in the 16th day. Actually, today will be the 17th day. So what you want to see on the follow-through day is where the volume comes in higher than the prior day. So that means that, we're getting buyers coming in. So this is the NASDAQ. We have multiple follow-through days, which is very, very positive. Here's the S&P 500, same thing. You got your low, and we're making new highs. So things look really good there. Now on the aggression index, which is where we're comparing an aggressive index to a defensive index, consumer staples. This has been a very valuable indicator. As you can see here, back around the beginning of the year, we started getting warnings that what you have to realize, you have to think like an institutional investor. So when you're managing $1 billion fund or a $10 billion fund, you just can't go to cash if you get defensive or you're worried. Well, if you're worried, you're going to start moving the portfolio more into consumer staples, utilities, defensive type things. And so you can see where these institutions started doing this right at the beginning of the year. Now, also on the buy side, you can see here we made the low, and we're now above the aggression index, which is a ratio now, is above both moving averages. We've got a golden cross here, and both moving averages have turned up. And you can see down here, here's the performance of the S&P. So this indicator has been very valuable. Now, if we look at it kind of on a long-term basis, just to see a past experience, this was the bear market of 2022-23. So you can see how it was an early warning. Once you start breaking below those moving averages, you should start becoming more defensive. Now, you can see here recently, this is up to date till now, we were doing quite well. Then we get the war and so forth. And we're coming down, and now we're breaking back up to the upside. And this is a very prolific move. This is a good move. Now, the primary trend is up. 200-day moving average for the NASDAQ and the S&P, the primary trend is up. So this is good. So the aggression index is saying get aggressive, and the primary trend is up, and also you've got follow-through days, which is very positive. Crude oil has been a real issue here. You can see here we had a major spike, has pulled back, got down to around 84, currently about 92, 93. What we would probably like to see is the downtrend resume, but it's going to have to start from a new higher base. New lows have improved dramatically. When we start to see fewer than 40 a day on the New York Stock Exchange, yesterday we only had 15. That's real positive because it means that the sellers are pretty much drying up. We haven't talked about sentiment in a while, but this is the AAII bull minus bear ratio. This is where we're measuring optimism and pessimism. Now, you want pessimism because that means that it's kind of a contrarian indicator. So sentiment is actually positive. But the thing about sentiment to realize is it can get a lot worse. But I think the worst is over, and I think sentiment's going to go the other way. Now, I've been noticing that the strength in the market and the leadership in the market, this is the king daddy. This is NVIDIA. This is like the Cisco system back in 1995. But you can see here, I was very concerned when NVIDIA broke below 170. However, like the market, it made a low and is now in an uptrend. So the AI thing appears to be back on. Here is the semiconductor ETF, the SMH. You can see that the semiconductors are definitely leading. Now, what I think could be happening here is that software stocks have really hit the skids because of concerns about AI and AI replacing the need for software. So I do believe that what's happening with a lot of these institutional investors is that they're reducing their exposure to software and they're increasing their exposure to hardware, such as semiconductors. So we'll see. Now, I did want to mention IPOs. The IPO market can be very tricky. And what I would really recommend to you on any IPO, and we know we got the SpaceX deal coming, which is 1.75 trillion valuation, which is kind of crazy to me. But you've also got several other companies that'll be going public. I just believe that it just pays to wait a while because you're going to get the initial surge. This is CoreWeave. This company went public back in April of last year. And we did participate in this move here, but you can see here as the insiders start to reduce their position, you can see where you just go through a really, really difficult period. Well, all of a sudden here, we're getting a major spike in volume, a breakout above the moving averages, and you've got relative strength here, which is compared to the S&P 500. The relative strength is improving and actually turning up. So keep an eye on CoreWeave. I think it's an interesting IPO, but it pays to wait about 6 months, 8 months, just depends. But when you go right in on the IPO, sometimes it works, sometimes it doesn't. So I would just really recommend that you try to get through that lockout period with the insiders. Now, energy is the #1 bottleneck for AI right now, but it's not the only one. There's a second major constraint that's getting less attention: severe shortages of critical electrical infrastructure, especially power transformers, switchgear, and batteries. Well, GE Vernova just announced earnings yesterday. The stock gapped up on the news, 4 million plus shares traded. That is what we would call a gap up buy signal, because what we look at on a gap up is we look at the 50-day average volume daily, and then we look for if we get a 150% increase in the average daily volume and we get a major move in the price, that's a gap up. So, this company is, they manufacture transformers and they're in the energy business, but they also do gas turbines and many products. But the stock looks good. Let's just see what happens. If you have any questions, please let me know. Thank you very much.